Welcome to the Down to Finance Australia Future Finance Group podcast. Today we're joined by two of our mortgage brokers, Mandy Evans and Sarah Bryden.
Hello.
And I'm Brendan Fredericks. Today's podcast, first home buyer special. Exciting.
Yeah.
Lots of changes lately.
Been heaps of changes.
Rate drop always helps.
Always helps for so many reasons. I think I love working with first home buyers. I know you guys do as well. And it's always just like a really good journey with the first home buyer. Yeah, satisfying.
Yeah.
I
love giving them that call when you get the formal approval and the screams at the other end of the phone. It just makes their day.
When
Absolutely.
you think back to like when you first met them and, you know, they might have only just started their savings journey. Thinking they were never going to get there.
Yeah. Because sometimes it's a 12-month journey. They come to us with very little savings and then put them on their way, and 12 months later.
Yeah, we get there. And it's like a little team journey. It's fun.
We get so invested in their journeys. It's so good.
Yeah, they're my favourite. So I guess today's obviously just about talking about what's available to you guys as first home buyers. We'll go through a couple of niche products and policies that are out there to help you get there as fast as possible.
Deposits, how much do we need?
Only 5% now for first home buyers, which obviously makes it much more achievable. The goal isn't as high for you guys. That's always really helpful for you guys. Only having to contribute 5% and not having to pay any lender's mortgage insurance,
so if
which is huge
buy a
saving.
$500,000 apartment, that's only $25,000.
Correct. Plus, then you've got your government fees and, maybe your conveyancing fees. So let's add another, $5,000. Let's call it $5,000. So, you'd need $30,000 to buy a $500,000 property, which is great. Plus, you're not paying any lender's mortgage insurance, which, off the bat would probably be 10, 12, 13 grand that you're saving. That's not being capitalised on top of your loan over a 30-year period. So it's not even just saving that $12,000 or $13,000 initially. It's the interest on that.
And the more expensive the property, the
goes
more expensive the LMI is. Yeah.
Now, if you do have a 5% deposit, it has to be genuine savings. How long do we have to save that up for?
Yeah, well, that is really a good question because we don't actually have to have it for the full 3 months anymore. It could just be that it could be in your bank account, and then after a day we can supply the lender with maybe a gift letter from a family member that might be helping out, or we could use other sources as those evidence for those gift letter for those funds.
So
some banks won't even require that supporting document as well, which is that's a newer one that came out.
Full deposit can come from mum and dad.
Or you've sold your motorbike and your car or whatever, your boat or whatever, whatever toy you're willing to part with. It can come from there, right, and be sort of dumped as a lump sum into the account. A little while ago, we would have to wait a minimum 30 days with some lenders or even 90 days with some lenders to show that you can genuinely hold on to that money.
Yeah. So if there's any mums and dads out there, kids might have overstayed their welcome.
5%, that's all it's going to cost you.
Get them out.
So that's a really good one. I will just mention as well, like obviously with first home buyers, you don't pay any stamp duty up to a purchase price of $600,000. And then once it creeps over that 600, it's heavily discounted between 6 and 750-ish.
That's Victoria specific, but every state generally has their own schemes, which we're sort of aware of and would apply obviously to
our Victorian clients. So really between the lender's mortgage insurance saving, only having to have the 5% deposit plus the saving of stamp duty, like you're saving huge amounts of money by getting into the market, now really.
Could be, $60,000, $80,000 difference there that you're saving. So it can be massive.
Now, if you don't have parents that want to give you a gift, but they do have a house with equity in it.
Yes. Did you know that you can buy a house with no savings whatsoever, which is, that's amazing. But a lot of people don't realise that is possible. So the way that we do that, it's called a security guarantor loan. So essentially the deposit comes from mum and dad's property. So we're putting mum or dad or a family member who's willing to put their security. You can do that as a second security, essentially. Again, avoiding your lender's mortgage insurance and also not having to have any savings. So that's a good one as well.
The kids are fully responsible for the loan, so the parents don't have to worry about it, so to speak.
You as the client would be making all the repayments. Mum and dad literally are just popping that up for the bank as a second security.
Yeah.
Yeah.
And some lenders actually take on the guarantors as well, who aren't working, which is great because a lot of parents, obviously retirement.
Yeah.
So they don't have to, worry about being working or anything like that. Some lenders do require the guarantor to be working. Most of the lenders that we lean towards, they don't have to be working. So, mum and dad can be retired and totally okay. So how long would the property from the guarantors be required?
Like we generally sort of quote or say to expect to be a guarantor between sort of 3 and 4 years. I've seen people as little as 18 months. That's really just determined by obviously the property market and the growth that you have, because obviously as your property increases in value, we're making up closer to having an 80% loan to value ratio, and once we achieve that, that's when we can remove mum and dad and say thanks so much, see you later, and we discharge their property. So as obviously the property market goes up, and depending how quickly that does, and then you're obviously paying the mortgage down, and then we meet sort of in the middle, and then we can remove mum or dad. So I generally will say, to allow 3 to 4 years, just in case.
To allow the property market to do its thing.
But depends on location and all of that.
Given all of our rate drops and things at the moment, this can be a really great time to get into the market if you are using or needing to use a guarantor, because hopefully we're going to see that incline in the property market happen sooner rather than later rates as well. So rates go down, property prices generally will come up. We can, it might not be as long as 3 or 4 years. If you were getting into the market now.
What's one of the most exciting changes we've seen for first home buyers in relation to potential income that they can use?
Yeah, servicing. So a new policy has come out that allows post-settlement for you to get a boarder in, that they can be paying you, a rent on a weekly or monthly basis, and then that can go towards servicing. So increasing your borrowing capacity by using the income from that boarder.
Yep. So some banks now will include up to $150 a week.
Yeah.
Correct.
Yeah.
As boarder income.
Yeah.
And that goes towards the bank's assessment of what you can borrow. So that's
it.
A huge amount of income that we can put towards
and we'd just be providing a stat deck from that boarding
person that they're going to sort of move in at settlement. So that has increased potential purchase price for our clients to get into the market. So it's the difference between someone getting a 1-bedder and a 2-bedder, or slightly better location or slightly bigger
block
plot
or
to
bigger house.
Meet their needs. So it's a fantastic
It's really
policy.
Great for those that are just on the cusp.
That's right.
They're struggling to get that little bit of extra borrowing capacity to get that 4th bedroom or whatever that might be.
Yeah, a really good policy that's come out. So what's your biggest advice? We'll go around the table for first home buyers. What can they do, or what's your...
My advice would be to obviously get in touch with a broker.
Sooner rather than later.
I'm a bit of a planner, so I love to put a game plan together. And just asking questions. Like no question that I ever get asked as a broker that I haven't heard before. So I think
there's no embarrassment.
No, I'm like, knowledge is power. So, the more that you know and understand, the more, confident and comfortable you will feel as well. But I think just putting a plan in place and really understanding the process and obviously having a good broker. That will help guide you and answer all those questions along the way would be my advice.
Mandy, your number one tip for first home buyers?
Oh, there's so many, but I guess the biggest one would be never rule yourself out. Like Sarah said, if you educating yourself is the biggest thing.
You don't know.
Exactly. And there's so many options out there that many of our clients don't even know about until they talk to us. A lot of them don't understand, the different schemes that are available or that they can combine schemes like the first home buyer guarantee with the stamp duty concession. So they don't realize that they're applicable for all of these options that they might not have known before, and they come to us and they can achieve so much more than they originally thought. So education is key, I think. We've
been through a couple now. Security guarantors, a lot of people don't know about that. No deposit required, 5% deposit, border income. Another one we'll not touch on today, but on another Mythbuster podcast, the removal of HEX debts by some lenders as a liability significantly increase what people can borrow. My number one tip for first home buyers is buy when you can.
Yes.
Because you don't know what's around the corner.
Absolutely.
A lot of, first home, going to wait for the market to drop, or Uncle John said, don't buy now, the property market's going to crash 20%. That's when you buy. It hasn't. So buy when you can.
When it's best suited to you.
Property is like a long-term game. So you're going to have this property, potentially 30 years. So if it does go down 10% in 2-3 years' time, it
always comes back.
Always going to come back. But you're no longer renting or living with mum and dad. In your own home, paying it down, potentially have a boarder helping you pay that loan down. So, my advice is always buy when you can. I remember I had a couple of first home buyers before, as rates were going up, like, no, hold off. Rates went up, affect their serviceability, and either couldn't buy or went from that 2-bedroom potential down to a 1-bedroom, which
not an easy pill to swallow.
Not what they wanted. So
yeah.
Fantastic. Thanks for joining today, ladies. Always a pleasure. That wraps up our First Home Buyer podcast here at Future Finance Group on the Down to Finance Australia cast. Thanks for joining.
Thank you.
Thank you.
Just remember to keep in mind, these podcasts are just general advice. And if you are after something more customized, reach out to your financial advisor, or you can reach out to us and we'd be more than happy to help.